Evening, ladies and gentlemen, once again. Welcome back to Syfe's one of the event one more time. And I see a lot of familiar faces here and also a lot of new faces. Happy to see every one of you here today. I'm sure it's been a busy evening. And then for today, you'll be talking about a very special thing that is happening to everyone. Everyone is always talking about this one thing, and I'm sure you're also talking about it. So this is called the retirement. How are we going to retire? How much is enough? And what can we do to improve our situation, right? So without further ado, I will begin. For today, we have a big lineup, right? We have a lot of people coming in to speak today, and of course, afterwards, if you're interested, you can also feel free to speak to those people and also network with them. We have people coming in from Dimensional, we have Dollars and Cents, we have the Joyful Investors, of course, from Syfe. And then for me today, it'll be more towards discussing a little bit more about the concept of retirement. How can we do it more often and what can we do better? And of course, my name here is Kenny once again from Syfe's advisory team. My role here involves speaking with clients to see how we can advise them in terms of portfolio allocation and how we can improve their finances. So for those of you here that is the first time coming to our event, a little bit of an introduction of Syfe. What we do here is we are a digital investment platform, more on the wealth management space with an aim of building our clients' wealth for a better future. And of course, down here, we are more of a in-app basis. Of course, we can do everything all in one app. So if you're talking about investing in our managed portfolio, you can do it through Syfe. If you're talking about investing in brokerage, you can trade it through Syfe. And if you're planning to save a bit of your cash for ideal situations, you can use our cash management solutions. So basically, all in one platform, and you can do everything here. Trusted by over 250,000 clients. Down here, we have billions of money. And of course, we have grown for a certain period of time. And I'd like to say that I'm being proud of being this journey so far. Started launch since 2019. And of course, from this page, you can tell that we have been going through a lot of situations. And I see some phones going on. Yes. And of course, stay tuned for more development from Syfe as we develop more and get more developed. So, one quick thing to mention is, what is retirement? Well, I'm sure everyone here, we have different views of what is retirement. Some people will have different meaning. Some people will have different ideals. But generally, retirement means being able to not work and still be able to live off your assets, right? And this is actually also a very subjective thing. Some people may view retirement in terms of health. Some people may view retirement in terms of having enough financial assets, right? So everyone think about retirement differently. But if you take a look at the life stages, we can clearly see they have 4 main cycles. First one is the 20s to 30s, which is around my range, fortunately. So this is a bit more of a special phase in life, whereby nowadays, people like you and me, we don't think about retirement as how we do in the past, right? Nowadays, the youngsters think of retirement in terms of FIRE. So FIRE means financial independence, retire early. And what people do here is they see lifestyle for retirement for lifestyle. They want to stop working because they want to, but not because they need to, right? So this is the kind of space. And the people here, although they're younger, but they're a lot more aggressive. So what they do is they save a lot of money, 60-70% of their income, and the rest is invested aggressively. But this may not be practical because not a lot of people can actually retire on 35 to maybe 45. But this is what they want to do. On the next phase, we have the 30 to 40s. This is actually more practical to a lot of people, inclusive of my parents, even your kids, right? They are people that prefers to have security, especially after 65. And the reason is because they're looking more for traditional retirement, trying to make sure that if they do go to retirement, their assets can fund their lifestyle for the rest of their life. So this is more traditional. Their mindset is more safety-oriented. It's also more stability, and of course, more practical. And of course, the next stage here will be a bit more on the catching up stage. So some of my clients is around 40 to 50s, and of course, they have like the next 10 years left to invest, correct? So what they do is they prioritize catching up. So a lot of people may not be there yet, but it's fine. We can still do something about it. You still have some life stages left to go with. So this is where they do more accelerating, right? Getting more funds for their investments. Ideally, what they want to do is to reduce risk, at the same time manage the stress for their financials. So a key thing they want to look at is things like their mortgages, the kids' education, perhaps even their car loans, right? So this is where they want to clear off all the debts and then fast-track themselves to retirement. Of course, on the last stage here, this is more practical for a lot of people. That's because they're focusing more on capital preservation. They have the money now, right, because they work hard for it. But now the question is, how long can they make this money last? So this is the key question for them. The mindset is more for income preservation, at the same time stability. All right. So now that we discussed the different phases in life, what do they mean in terms of challenges? Because everyone sees things differently, but there's one thing in common: challenges. Nowadays, I'm not sure if you're aware, life expectancy in Singapore is around 83, 84 years old. For guys, 81, 82. For ladies, 86, 87. Don't ask me why, but guys tend to live a bit shorter. But generally, most people do outlive their savings. I hope not. But generally, 20 to 30 years will be the time they use for retirement. So assuming you're retiring at 65, just from there, you're going to retire at an age of 85 or maybe 90 years old. So what if you live longer, right, with medical advancements? So this is something we have to consider. Rising costs. 1 in 2 worry that they may not be able to fund their full retirement. Okay, and this is also very true. It's a situation. And over 70% expect the inflation to affect the retirement. So of course, healthcare is always going to be an issue here. And then obviously there is a retirement gap, right? Because what else can we do? Retirement is going to be expensive. Your health is going to deteriorate. Healthcare is going to be expensive. And then CPF is not going to do much for you either, right? Assuming you have 200, 300K inside. And based on our statistics, we take about 1.2, 1.4 million to retire comfortably. Right? I'm not saying basic, right, but a bit more comfortably. That means there is a huge gap that we have to cover. Okay? And today, we will discuss a bit more on what we can do for this segment and how we can improve this situation for retirement. First thing we want to talk about for retirement on a basic level is that we have CPF. Okay? This is something that we always have and we already have. And the good thing is, every year this number increases. So it helps you to plan for your basic retirement needs. And right now, BRS, basic retirement sum, is hovering around 107K. FRS, ERS. The pattern is 2 times and 4 times of the basic retirement sum. And if you look at the right side, you'll notice that this is the amount you'll be receiving at 65. And that range from 840 to 3,003, depending on how much you have. But the issue here is, most people will settle at full retirement sum. Okay? Because maybe they have different needs, but generally 1.5 to 1.7 will be something you'll be expecting. And that's for sure not going to cut it, right? So if you just do a quick math, if you really need to have a basic retirement life, not so savvy, not so lavished, not flying around for holidays, unfortunately, then maybe about 3K, 3.5 will be something you're looking at. And if let's say we use the FRS system, then you have a huge shortfall of around 2,000. And when that happens, what's going to happen to us? And don't forget, these are not inflation adjusted, okay? So definitely things will be more expensive, you will need more income to retire, and that's a for a fact. So what else can we do for savings other than CPF? In this case, we have things like SRS. A bit different. It's not like CPF, whereby it's a bit more mandatory. This is more voluntary, right? So some clients will want to use SRS to save, right, to complement the retirement. And the good thing is SRS can help a little bit in terms of tax relief. So some of you have known this and have also used this. You realize that they can reduce the taxes by a little bit. At the same time, help with investment returns. Good thing is contribution is on a yearly basis, although there's a cap, 15.3, as well as this 35K for foreigners. But I would like to say this very importantly. Benefits of SRS is going to be good, but it also comes with a cost, right? Contribution is good, but you can't keep everything in SRS. Because if you are not aware, SRS is a system whereby it locks your money up for some time, and only after statutory retirement age, then you can withdraw. Okay? So that's one of the key features that you have to understand. And when that happens, of course, tax-free investment returns, flexibility to invest. Some of my clients asked me earlier how we can invest SRS money, so today we'll speak about it. Other than that, tax concessions. The one on the left shows you If you do use SRS, potentially you get some tax relief. But if let's say you don't, of course, this is not the end of the world, right? Because you can still use your funds for other things. So SRS is meant to be a good sweetener to help you reach your retirement goals faster, potentially lesser risk and lesser tax. All right, so at this point in time, I've speak a lot. I would like to invite Ritesh up to speak a bit more on how we can invest further from CPF, a bit more on the long-term goal. This person is requiring no much introduction. He's always been here for a long time, always speaking with our seminars and webinars. I'd like to welcome Ritesh, our Managing Director, Head of Investment Advisory in Syfe.
Thanks, Kenny. Hi, everyone. Thanks for coming in here. As Kenny mentioned, I head up the investment strategy at a group level at Syfe. And for the better part of the last decade, I've really focused on helping individuals to align their investments with their long-term goals. So today, in this part, I'll really cover how can you go beyond your CPF to plug the gap with respect to your retirement needs. And there'll be plenty of numbers, so we'll start here, but I think we really need to focus in this part of the section if we want to understand what's going on. So bear with me, there will be a lot of numbers, but it's important to go through them clearly to understand how you can plan better for your retirement needs. So Kenny mentioned that the retirement gap is actually 1,910. The reality is it's not 1,910 because what happens as we progress further, inflation picks up. So what you can buy with that $1,900, you will not be able to buy as you move forward. So if you put this in 20 years ahead, 25 years ahead, 30 years ahead, the gap, which was 1,900, close to doubles to 3,600. So that's the actual retirement gap or the shortfall that you have and that you need to manage beyond what you will be able to generate from a CPF-only standpoint. Now, that's the retirement monthly income that you're seeking, and that's a basic retirement number that most of the people have. What does it translate into in terms of a lump sum amount that you need to have to really get to that retirement income? And then there is this rule of 4%. The 4% rule basically says that if you require a certain monthly income at retirement, what is the lump sum that you need such that that lump sum, if you withdraw 4% every year from that lump sum for the next 25 years, that will last you for those 25 years. So that's what the rule of 4% is. And that number comes out to be $1.1 to $1.2 million because you multiply 3,600 by 12 times 25, right? So just have that number in mind right now. This is the most basic number that we need to get to beyond what you get from your CPF and so beyond what you get from CPF. So through your SRS investments, through your cash investments. And there are really two phases of lives that we all have, right? Like there is the accumulation phase and then there is the decumulation phase. And a lot of us are right now in our accumulation phase because we have jobs, we earn, we save money on a monthly basis, and then we can contribute towards our retirement needs. And that's really the foundation that we are setting up, and we have time horizon to do long-term investments and contribute towards the retirement gap. Once we reach the retirement, then that's where the decumulation stage kicks in, because at that time, the cash that you're generating starts to dry up because you're retiring, you don't have a monthly income, but now you've accumulated wealth through your years of working. And that is what then helps you walk through your retirement needs. And then there is a cash drawdown. You want a lot more certainty with your return. In your accumulation stage, you are really looking for growing your money. In your decumulation stage, you are really looking for capital preservation and income, right? So we really will drill it down further in terms of how then you can plan for these individual sections. And we'll have a lot more numbers. So please, again, do take a look in terms of what's happening. We cover a case study. So this is Melissa, 35-year-old, currently generating an income of $5,500 on a monthly basis. She has some current financial obligations, meaning that she's able to save on a monthly basis $1,600. And this is the amount that she's ready to commit for long-term investments, right? And then she has a few goals. And it's not just retirement. Like all of us, we have various goals. We have our children, so we want to plan for their education. We might have parents that we want to take care in terms of their healthcare needs as we move forward as well. So there are all these different needs that are coming in alongside your retirement, and that's what I call like the sandwich generation. I belong to that generation because I need to plan on both sides as well. Now, this is where things get interesting because we came to that number of $1.1 to $1.2 million that you need to accumulate. Now, her budget is $1,600. How can she distribute this $1,600 across her SRS and cash investments to really be able to get to those long-term figures, which is at age 65? And it does the forecasting for you. So if you see, what she's doing is basically on SRS, she's contributing $300 a month. On the cash, which is meant for retirement, she's contributing $800 a month. And then for child's education, she's contributing $500 a month, right? So if you grow all of these pots of money at these respected assumed annual interest or return rate, that's how the money then grows over time. And what you can then see is on the SRS side, you're getting close to $340K. On the cash for the retirement side, you can get to $1 million. And then for your child's education, because if her child is 6 years old, at 21, she wants to plan for her university education. So this money will be drawn out, so it'll go out. And now, again, there are a bunch of assumptions in this, but the fact is that with a very limited pool of contributions, she's able to actually hit that $1.1, $1.2 million fairly easily. But the important thing here is to note that you need to contribute regularly, you need to be disciplined. And then there are actually much more possibilities to go much beyond this, because after her child's education is funded for the 15-year, that money can go back and be contributed towards retirement, right? Her salary will increase over time as well, so she will hopefully have more savings as she progresses further as well. So all of those will help her to get to an even better state than what we are projecting over here. And then there's the decumulation phase, right? So we talked about the 4% rule. Now, according to the 4% rule, if she's trying to get to $3,600, she only needs that $1.1 million for her retirement need. What that means is she can also plan to leave some legacy behind. So if she's left with a lump sum of $300K, because the total lump sum that she's generated is $1.4 million, right? So if you add the fact that on the retirement side, she only needs that $1.1 million, the other $300K can actually be invested in more growth-oriented assets, right? And that can be then passed on to the next generation as well. And then the investment universe changes as well. Again, on the retirement side, she would want to be a lot more conservative. The objective is to preserve that capital to generate regular income. What that means is the investment universe will be more bonds, REITs, dividends. These will dominate how she's investing on the retirement side. But because on the lump sum side, on the bequest side, she's investing really for another 30 years, right? Like 65 years of retirement, and then 20 to 25 years for her to grow that pie and then pass it on to the next generation. So it doesn't look that bad, right? Like, when you put all of this together, actually, there is a lot more possibility. And that's where Syfe can help you in terms of getting to that better state. And we, as Kenny had covered earlier, we have solutions across the breadth. So we have cash solutions. So if you are trying to get a better yield on your cash savings, there are cash solutions available. If you're trying to generate income and yield, we have an income portfolio which generates close to 5 to 6% monthly returns and monthly dividends that can be then utilized for your income needs during the decumulation phase, as we were talking about. Similarly, REITs, Singapore, dollar denominated, no currency impact, 5.4% as well. For people who are more in the accumulation stage, obviously the growth-based strategies is where you would be dialing up on, right? So we have our core portfolios globally diversified. You have your equity portfolio, which is 100% equity, but then you can combine it with bonds and other asset classes to make sure that it is much more smoother ride compared to a pure equity, which can be much more volatile as well. And then if you are someone who wants to be in full control with your investment and you want to invest the way you want, then there is a brokerage platform. So you can buy ETFs, you can buy stocks, and then you can, again, plan for your long-term needs through the brokerage platform as well. And on the SRS side, which is one of the aspects that we talked about beyond your CPF, that's where we have also dedicated portfolios on the cash side, bonds, as well as equities. And on equities, we will hear more from our partner today, Dimensional, because we construct our equity portfolios with Dimensional as our key building block in terms of the underlying strategy. So they'll share a lot more in terms of how, when it comes to long-term investing, how you should be thinking in terms of equity markets and beyond as well. More importantly, I'll just get a little bit more concrete into the accumulation and the decumulation phase. So we talked about generating those different returns for the future value, which was the 1.4 million. And if you see in here, these are sample allocations. So how can you use, again, Syfe to get to these outcomes? There are strategies that you can invest into, and assuming you generate these kind of returns, it's actually possible for you to get to these accumulation goals. Similarly, on the decumulation side, you again focus a lot more on income-generating assets, right? So if you look at the retirement bucket where you're putting $1.1 million and you are trying to generate that 3.6K as the monthly income, if you see this, you're mostly investing into investment-grade bonds, you're investing into REITs, you're investing into dividend stocks, bank bundles, and maybe some cash just to use and utilize for emergency purposes as well. But this combination is able to give you around a 5% dividend yield, which I think is pretty good from a retirement standpoint because it is well diversified, it is pretty stable, it is income generating, and it can preserve your wealth while also generating you that monthly income for your retirement. At the same time, on the other side, the bequest, where you want to leave that legacy behind, you can still invest in more growth-oriented assets. So that's where you see the strategy here is much different. You're investing into equities, you have some satellite allocations that you can do as well, but the fundamental difference there is basically the fact that you're solving for growth even during your retirement, and you are able to leave that legacy behind. I will leave this part of the session with just a couple of closing thoughts. And this is one of my favorite slides because it kind of captures how you should be thinking about investments and why timing the market and trying to think about what is the right time to invest into the market. These are all things that hold us back. So in this example, there is Jill and Jack. Jill starts investing at age 30, keeps investing $10,000 till age 40, and then stops investing. Jack, on the other side, wakes up a little bit late, but because he's late, he's saying that, okay, I will do double of what Jill is doing. So instead of doing the investments for 10 years and contributing only $100,000, I'll contribute $200,000 for 20 years, so naturally I'll be better off, right? The question is, at age 65, who will have higher assets? Any show of hands who think Jill will have more money? And who all think Jack will have more money? Okay, everyone knows the strategy here, but yes, exactly. So you see, the difference is quite pronounced, right? So even though Jill only contributed for 10 years, the fact that she started so much earlier, this is the effect of compounding. And this is what I would like all of you to take back, because when it comes to investing, don't overthink. Have a disciplined and systematic strategy, deploy into the market, have that runway of 20, 30 years. And what you would want to do is make your each and every dollar work for the longest possible time. Yeah? So we'll talk more about it in the next sections. But before that, I'd like to call on Sam from Dimensional. Just a quick background, Sam is the regional director for Dimensional here in Singapore. Dimensional needs no introductions, but they are one of the biggest asset managers globally. Their strategies are index-oriented, but they also amplify it with factor-based overlays. And these are systematic ways to generate better return, better risk-adjusted returns. And these strategies are grounded by decades and decades of research. And the company itself is founded by Nobel Prize winners. I myself have the fortunate thing of actually going to a business school where one of the founders of Dimensional, started their genesis as well. So it was started in the University of Chicago, where the foundations of factor investing were laid into place, and then David Booth, who is the founder of Dimensional, took it to the next level. So I'll let Sam talk more about it and give that perspective as well. Sam, over to you. Thank you.
Good evening, everybody. So I'm originally from the United States, and today is a very special day in the US. It's Thanksgiving. So I want to extend my heartfelt thanks and express my gratitude for being here with you all this evening, and for Syfe for having me. So my name is Sam Gillespie, Regional Director for Dimensional. And as Ritesh mentioned, Dimensional is a global investment manager. We have our roots in academia, roots in academia, and our processes are vetted over decades. Now, what we want to talk about here today is how to create better investment and retirement outcomes for you all. I think in the slides that Ritesh was sharing, there's lots of numbers, there's lots of hypotheticals. We are inundated with those every single day. But what we want to do is ensure that we're going to be okay over the long term, right? And I want to posit to you all that it's very easy to get a good return when investing in equity and fixed income markets. The biggest impediment to that growth is yourself, right? We've seen charts like the one on the screen behind me. This is the hypothetical return of various portfolios, a fully equity portfolio, so 100% equities, 0% fixed income, 80-20, 60-40, over the past 25 years, which I think is a reasonable time frame to invest. Right, that would have turned $1 into nearly 8 for the 100% equity, $1 into 6 and 3 and 2/3, and 560. Now, the chart here is simplified, right? These potential or hypothetical outcomes are easy to model, right? But the real ride looks something like this. It's a lot choppier. There is real world volatility. And so we have to ask ourselves, what is the best way to put our best foot forward to get the appropriate return and the outcome that we need? And that is what Dimensional has spent the past 45 years doing. Some of the folks that Ritesh mentioned, those professors at the University of Chicago, seminal research that they have published over the years, which have transformed the way that people invest around the world. You can thank the 3 people on the left of the screen for index funds. If anybody uses the Syfe SRS 100% equity portfolios, there's Dimensional, there's also Amundi. That is based off of indexing, and that technology was born out of the University of Chicago. Now, these folks helped found Dimensional. They were our very first boards of directors, and they're still involved in the firm today. But their job over the past 45 years in working with Dimensional and working for the community at large, the finance and economics community at large, is to produce better outcomes for investors. Now, the problem is that as consumers, we are pulled in different directions every single day, right? There are folks telling us to invest in this, to invest in that. There's an AI bubble. There's this, that, and the other thing. I get into the lift at Asia Square every single day, and there's Bloomberg on with various outlandish headlines. They exist to get our attention and to get us to act, because lots of folks that publish these things want us to transact, and perhaps they make some sort of revenue off of our action, right? How do we tune out that noise? Lots of the folks that we look to in the media and we trust in the financial landscape, right? They are compensated to have a view. Those views are very frequently incorrect, as you can see on the slide behind it. So those things are difficult. And as individuals, how do we move forward, and how do we typically invest? Right? We typically have a process which is based on predictions. This is the average investor. None of you here in the room, of course, right? We have some sort of prediction. We're looking over the short term, right? You're hoping for some good outcome. It's not based on science. It's not based on rigor, right? And it creates anxiety. Does anyone invest in crypto? Past 3 weeks have been extremely anxiety-inducing. I have a small sliver of a portfolio myself, right? Not super fun to open up my app. but you just hold on to it. You try and tune those things out. I would say that using, I guess, the resources that we have at our hands, whether it's Reddit or, God forbid, TikTok, there are some good and reputable people creating good content. I think Syfe will be producing some stuff there in the near future, but there's lots of trash. Using that information, we probably push forward and we gather up a portfolio of just a handful of names that we know and we love. The problem is that these portfolio constituents, these individual stocks, they move up, they move down with a lot of random movement. Very difficult to understand and predict when they will do well and when they're going to do poorly. The names that we know and love tend to do really well in the years preceding our recognition of them. But then from the time that they become the best participants in the market, think Mag 7, on average, if you move forward 3, 5, and 10 years after they became recognizable names, they don't continue to give you that return, right? If you were to build a portfolio of individual stocks over 20-year rolling periods going back to 1927, there is a huge underperformance relative to the market, right? This chart plots out the fact that over 20-year rolling periods, the top stocks, only 40% survived, and only 18 beat a broad market index, which are terrible odds. So if you're building an individual stock portfolio, we've seen that that's very difficult. So you might turn to unit trusts. Now, this data here on the slide behind me plots out the performance or outperformance of active managers of unit trusts over 10, 15, and 20-year periods. You can see in the light blue that that outperformance rate is quite difficult. It's quite poor. So if you have long-term retirement goals, I wouldn't posit that an 18% chance of you outperforming a market index is pretty good odds. You could probably go downstairs to the casino and do a little bit better. Now, there are good unit trusts out there. There are fantastic investment managers, and sometimes they do really well. I want to tell the story of Fidelity's Magellan Fund and Mr. Peter Lynch from 1977 to 1990, a 13-year period. He got his investors a whopping 29% per annum. But in the years after he stepped down, people went back and they looked at the returns that the folks that were actually buying and selling the shares of that fund garnered for themselves, and it was a paltry 7%. And so when I propose to you all that getting a good return is something that you are all owed and is possible, you are your own worst enemies, right? Why did those folks get 7% per annum when the fund got 29? Not because they're stupid, but because they are human, like you and me. They react to fear and greed. They piled into his fund after he had done well. Buy. There was obviously randomness and market movements. He got calls wrong from time to time, and when the NAV of the fund went down, they sold their shares and came out at the wrong time, and they did that on repeat until broke, right? But the truth of the matter is that by owning a globally diversified portfolio like the ones that Dimensional manages and the ones that Syfe puts out for you to use in the Core Equity 100 portfolios, we can do well. There is lots of noise. There are lots of bits of turmoil. There will always be crises that feel really, really impactful and important. But through time, markets have rewarded investors. That is the fact of the matter, and that is measured here on this chart. This is an index of basically the world's stock market, both developed and emerging equity markets, plotted out through time. You can see despite the crises of the day, the returns were still positive through time. Now, owning that index, just a broad-based index, very boring, not sexy, unfortunately, that would get you nearly a 10% return per annum. That was the return over the past 14 years, 2010 to 2014. If you thought that you could do better than that, and you didn't own or didn't include just the top 10 or 25 individual stocks year after year, then your results go down drastically, right? And you don't have to take that risk if you can stay disciplined and patient and diversified in your approach. You are owed that 9.8% return, right? That is just the truth. Now, people will frequently ask, ooh, there's a lot of noise out there. There's a lot of anxiety. Is now the best time to invest? I saw on Bloomberg that the S&P, or the MSCI World, is an all-time high, right? Oh, no animations. Well, the punchline, because there's no animations on here. The punchline is that 1, 3, and 5 years after an all-time high, or after the market has retreated 10%, the average return of the S&P 500 index and many other indices like it is almost identical. It doesn't matter if the market is at all-time highs or if it's come down 10%, the resulting forward-looking returns have been largely identical. So it's always a good time to invest. Now, some folks will have different, parameters in terms of their requirements for liabilities based on their age, but if you have a long enough time horizon, you should tune out all of those things. So how does Dimensional invest our portfolios? We've relied on those really smart guys. I'm going to try and speed this up because we're not here to really talk about Dimensional. But we've relied on those really smart guys to identify different types of stocks and areas of the market that have done better through time. We have one investment philosophy. We're managing over $1 trillion Sing dollars. And I share that because we are stewards of other people's wealth, and we truly believe that if we could be doing things a different way, then we would do it. The things that we look at to try and drive out performance in our portfolios are small stocks, cheap stocks, and the stocks of highly profitable companies. These things are intuitive. If you think about a small cap stock, it is less established than a large blue chip name. If you think about buying something cheap, which is relative price, you want to buy something cheap instead of expensive, all things equal, you'd probably want to spend less on an HDB than more because you have higher room to grow. It's easier to double, right? And obviously a good company, one that is kicking off a lot of profits, is going to be a better investment as well. Through time, we've seen that small stocks have beaten their large counterparts. Cheap stocks have outperformed expensive stocks. This is evidenced by the lighter colored bars across, and those stocks of more highly profitable companies have done better than those which are not profitable. It's all intuitive. And through time, when we look at the resulting compounding effects of having exposure to value and small companies and those which are more highly profitable, at least in the United States back to 1964, you can see that they did a whole lot better than everybody's favorite index, the S&P 500. All right, so how do you combine that into a portfolio in a methodic way? This is the last slide about Dimensional. You can work with a partner to help you implement, like Syfe, right? You can build portfolios which target specific areas, as is evidenced on the right-hand side, or you can look at what we call a core approach, which targets all three of those types of research in one time. But really and truly, you can rely on an implementation partner, right, to do the research for you, and that is exactly what Syfe is here to do. I want to leave everybody with an anecdote about my dad, a real-world example of what is at stake for everybody here, because he is a human just like you. He was a postal worker for 37 years, just a normal guy. He thinks he knows a bit or two about finance, but he has absolutely no idea. This was his portfolio from October 2016 through to February 2024, when I started helping him pick and choose what to invest in. Had he been invested in the S&P 500 as it was up until October 2016, that $400,000 that he had in his SRS equivalent type portfolio, like a CPF OA, would have grown to over $1 million. Now, the fact of the matter is that I am from the United States, and not only am I from the United States, I'm from a place called Boston. Boston is very liberal, and it does not like Donald Trump. Red is Donald Trump supporters, blue is not Donald Trump supporters, and he happens to be from Boston as well. So he thought the world was going to melt down in 2016. So he took his investment, he swapped it out of the S&P 500, and he bought T-bills, $400,000. He then never revisited his portfolio until he called me and he said, Sam, do you think I could reposition things? And I looked and did the calculation, and instead of having over $1 million in his portfolio, he had just $27,000 more than the 8 years prior. Right, so don't succumb to your fears and your temptations. Have a plan, stick with it, stay focused on the long term. If you can and you believe in the research, then employ an evidence-based strategy like the one employed by Syfe, and that will result in an experience which is much calmer and will help you to reach your goals in a much more steadfast manner. So with that, thank you all very much. We are outside if you'd like to chat, and thank you for spending Thanksgiving with me.
Thank you, Sam, from Dimensional once again. Very nice speech here. Of course, it also relates for us. I myself have been speaking to my clients and totally agree with you. Markets are always full of noises. What's there to report on the news if there's no drama, right? So, moving on, we will be heading to the fireside chat. And this one, I would like to invite our panelists up on the stage, please. We have Charmaine, moderator and host for tonight. We have Timothy Ho, co-founder from Dollars and Cents. We have Hazel, CEO and Chief Trainer for the Joyful Investor. Of course, Ritesh, once again from Syfe. It'd be nice if you can sit according to the orders. All right, thank you so much. And there you go.
Thank you. Okay. So we're now going to be having this very delightful panel here, diving straight into retirement planning. So I'm Charmaine E. Thank you so much for the introduction. But we have the panelists here. I know a lot of us were very excited to talk to this panel earlier on. Some of you managed to get one-on-one time with them. But today we've got 3 experts, and we're going to be talking about diverse perspectives here: retirement planning, SRS, investment strategies, and hopefully everything else in between. So to kick us off, I know we have your bios right there, but give us a little introduction of what you do, and I'm going to add on to that, the most pressing financial priority for you right now. Go ahead, you have the honors.
Hi, I'm Timothy. I run a website called Dollars and Cents, so I've been doing it for about 10 years in time, so since 2015. Along the way, I have 3 kids as well, so over the last 10 years as well, so 3 daughters. And the biggest financial priority, right? Okay. So for me, I'm part of the sandwich generation. I wouldn't say that they are financial priorities. I think they are more like life priorities, which is something that, as parents of young children, you want to see your kids grow up well, holistically in Singapore, and the kind of experience that will make that, hopefully better allows. So I think a lot of our life decisions right now, for me and my wife, has to do with that as well. So, for example, upgrading the home and all those kind of things, right? So I get your life priorities comes first, and then your financial priorities follow that. So that's on me right now.
Hazel? Hi everyone, my name is Hazel, and I'm the Chief Trader of the Joyful Investors, which is a financial education firm. So what we do is we empower everyday investors like you guys on how to invest more prudently, make more informed investing decisions, so that eventually you build wealth, and that's where you can then achieve the financial goals that you want to achieve, whether it's a retirement, financial independence, financial freedom, right? Aside from that, also SGX Academy trainer, and I'm a speaker per year. So sometimes if you attend some of those webinars by CV or seminars, in-person workshops as well. So one of the most pressing financial priority for me, I would say it's not just at the moment, but for the most part on this journey, to me, what I always focus on is how to build my wealth consistently and sustainably over the long term. So that is a guiding principle, and yes, that's very broad-based, right? It's a very broad-based perspective, but I like to take that kind of mindset because in this journey, I realized that if I am able to build wealth consistently and do this consistently over time, eventually you will be able to tick off whatever things that's on your checklist, whether it's getting married, buying a house, buying a car, traveling for a long extended period of time. Those are the things you'll be able to meet if you are able to do this consistently over time.
Thank you so much. Ritesh, we know what you do. Maybe tell us what's your most pressing financial goal.
I think, you mentioned it earlier, is, we are all part of the sandwich generation. The juggling between the different priorities and how do we allocate in these different goals is where things become much more complicated. So a lot of time gets spent in terms of just thinking through what are my short-term goals, what are my medium-term goals, what are my long-term goals, and how do I really align my investments to make sure that I'm on track to meet those goals and even do better. And I think what prevents all of us in sticking to a plan is how the markets move. And if you think about it, like, when you invest for things like insurance now, of course, there are problems when it comes to insurance in terms of the fact that they are, there are a lot of features and certain merits, especially like the IPs and all. But one thing that makes it better is the fact that you don't have daily your market moving and the portfolio going up and down. So I wish, like in investment world as well, we don't have to show you the daily moves, because that will help us invest in much more responsible manners. And then if you are reviewing your monies not like every day and every quarter or 6 months, I think it helps us just be a little bit more, not totally emotionally trained, but we are doing things in a much more rational manner. So those are things that I still try to balance myself and making sure that these now-to alignments are in place.
Okay, let's deep dive into the retirement planning. When all of you think about retirement, has your perspective changed over time? Maybe Hazel, you can kick us off.
All right. To me, retirement, my definition of retirement, it has evolved more into seeing it as like a journey towards getting to financial independence rather than seeing just as an ultimate destination. So what I mean by this is that if you ask anyone on the streets, what's your idea of retirement? Most people will tell you it is about when can I finally stop working? When can I finally no longer wake up to my alarm bell and go drag my way down to work, to office, right? But to me, my definition of retirement is not something like that. It's about how or when can you finally design a life whereby today, even if I want to go to work, I'm going down willingly. This is something I choose to do. So in other words, if you really look at many of those cases of people who have achieved retirement, so-called retirement, actually there are many of them, they continue to work, but they choose their work in a particular way in which they like. Like if you don't want to go for 5 days a week, they can do part-time. They can do by project. After I'm done with this project, I can take a break and then I move on to another project when I'm ready, right? Or maybe I can give back more to the society. It doesn't pay me well volunteering, but it is something that I like to do. But by then, you are all right to do something like this because you no longer need the active salary to pay for living expenses. You have your passive income from your retirement portfolio, for investment portfolio. And in fact, I have seen this play out firsthand where I have one of my community students who, after joining us for about 5-6 years later, he has already achieved financial independence. And recently, we were just catching up with him. So he has gone for about 1 full year of traveling, right? And after coming back, he realized that actually something is still missing. So initially, he thought that, okay, I would want to travel for the rest of my life once I so-called retire, right? But after he's back, he realized actually he doesn't mind doing some work in areas where his strength is, where his passion is. So something like this, I think it tells us a lot about how we can rethink about how this definition of retirement is really to us.
Tim, you're like nodding away. I'm guessing, did you have the same kind of shift as well, or?
I think when I was young, like most of you guys, I was led to believe that retirement is a number, right? Most of us think of retirement as a number, whether you want to work till 65 or you want to early retire at 45, you think of it as a number, right? I like to just suggest that retirement, if you think of retirement as a number, there is a little bit, the government will say it's correct, but I will say that maybe it's not the full answer as well, that retirement shouldn't be thought of as a number. Retirement technically is actually when you decide to give up your job to someone else, if you think about it, right? So if I choose to retire from dollars and cents today, meaning that I'm choosing to give up my job to someone else, right? If I retire from the national team, football, I'm not stopping work, right? I'm just giving my position in the football national team to someone else. So you got to think of retirement not in terms of a number, but in terms of me giving up my job for someone else. So then the question naturally becomes, okay, if I retire and I give up my job to someone else, will I have enough money or do I need to find something else to do, right? Which is the whole idea of investing, which Hazel was talking about. I always share with people that there's typically two ways of making money, right? You either work for money, so you exchange your time, your skills, your experience to make money, which is what MOE teaches us to do, or you make money work for you, correct? That's investing, which is what Ritesh is teaching us to do, right? So in life, there's no such thing as one is correct, the other is wrong. We just have to think of it as parallel strategies to make money. You either work for money or you let money work for you. So I think in Singapore's education, we have done a very good job in addressing the former, which is how can you be a productive member of society and contribute to society, right? If everybody's an investor, then who's going to work, right? But I think as an investor, we are responsible personally to do so, which is why that is my answer. You got to invest as well. Even as you work, you got to invest as well.
Is that something you're seeing? Most Singaporeans are having this shift, seeing that we have longer expectancy. Ritesh, you were talking about this as well. But maybe while we still have the mic on you, are you noticing that Singaporeans are making a shift?
I think there is a generation, like my parents' generation, where they definitely think of retirement as a number, and when they reach the age, they get their CPF life payout. Hopefully it's enough for them, right? I think the younger people don't exactly look forward to, hey, I'm 25, I'm going to spend the next 40 years working, and hopefully at 65 I have enough money. I don't think that is the aspiration for as many young people today. So people are redefining their life as well, right? They want to make sure that if they want to take breaks in between their 40 years job, they can take breaks. They don't necessarily want to buy the biggest and most expensive house, but what they want is the flexibility to maybe stop work and look after their kids if that's what they want to do, or travel the world. So I think people are no longer as excited about retiring at 65, and that's why there's a lot of redefining of what it means to really live your life the way you want.
So for you, 65 is like a big retirement, right? Hazel, you talked about micro retirement. You feel you've observed this, right?
Yes. I guess these days, right, when you talk about retirement, it's no longer just about, okay, I work all the way and then stop. That's it. But rather, something like what Tim has actually mentioned, there are some of them, they will work and then they take a break for a short period of time before they move on to their next career. So they repeat this journey. So, but obviously, in order to be able to do this, you probably have to set aside some assets that is sufficient as well to be able to do this. So that is one variation of retirement and one shift in the way that people do it. On top of that, I guess there are really people who are thinking earlier about retirement, this idea of retirement. No matter what your definition of retirement is, but there are some young people who are really taking action. And I have seen this, some of my community members, they are very young, like in the universities, and they're already taking action to start investing. So this is something that I feel that is really encouraging to see. In fact, I have seen before parents who want their kids to be educated about investing while their kids are still studying in, say, secondary school. So you might be wondering, how come in secondary school shouldn't you be focusing on your O-levels, on your studies, right? But why the parents have such mentality to expose their kids is because some of them, they have started on this path too late. And they don't want their kids to walk that same old path. And that's why they're doing something about it. Even if they can only understand 40%, 50% of investing, it's fine. You are better off than you at 0%, right? So I think all of these signs and examples really illustrate to us how, yes, indeed, there are more people who are thinking about retirement, planning, building wealth, maybe not so much for the kids about retirement, right? But starting the journey of building wealth, which eventually leads to your retirement planning.
Ritesh is like nodding away there. Is that something you've observed as well? A shift with the Singaporeans when you do look at the portfolios?
Yeah, absolutely. Look, I think at the end of the day, we all are here to serve a certain purpose. Like we are all purposeful in life, and different stages of our lives, what we want to achieve changes as well. And Kenny, I think, covered it earlier that when we are in the 20s and 30s, we are chasing returns, right? We've just discovered the stock market and, these big companies generating, high returns. I would just want to pile on and get the highest possible returns, right? That's how we're just geared towards. And the FIRE movement is actually real, right? People want to get to that $1 million number and then have the choice, as you guys have mentioned, in terms of what they want to do. So I think that's a big aspect that has, transformed how people are thinking about investing, and then making sure that basically from a lifestyle perspective, I have the choice to define my lifestyle and what I want to do and what I want to pursue as well. So this is one of the changes that I've seen more particularly. But beyond that, I think the fundamental aspect remains that we want to be making sure that we are covered from a very basic hygiene perspective, right? And that, I think, is still the biggest fear that all of us have. Like, will I outlive my savings? And is there a way for me to make sure that I put that foundation in place to achieve those basic requirements in life, and then I can dial it up from there? And that's where I think the lifestyle choice becomes important. What kind of life do I want to lead? And with retirement ages, extending further, plus the life expectancy like going further as well, you're looking at 20 to 30 years plus of retirement lifestyle, right? So in my case, what I try to do is I want to make it like very, very methodic in terms of how I invest into the market, right? So bulk of my money, when I am investing, I'm investing with Syfe into managed strategies, which are long-term oriented, and I can just automate my investments, right? Contribute that monthly. And that's why, some of the slides that you saw as well, I purposely want to do it in a way where I can identify and I can organize my investments in a way where I have some clarity. This is where I'm investing. This is how it is diversified. Whatever happens in the market, I know I just need to follow that discipline. So I just keep going, keep going, keep going. And this is a change that needs to be incorporated in a lot of investors, because especially the younger investors, they would want to pile on and ride the wave. There is these Reddit forums, there is Wall Street bets, etc. and all. When the going is good, everything looks shiny. But come like Liberation Day, a week before, there was this AI bubble-related rhetoric, etc. We saw market selling off. What happens then? People panic, people sell. And that's the worst thing that you can do, right? And it comes back to how you're investing. Are you investing into single stocks which have large drawdowns and that will impact you in your night's sleep? Then maybe it's not worth it. Think about diversification.
So in your slides, earlier on when you were presenting as well, you shared that relying on the CPF system alone is not enough. Maybe you can take this opportunity to share a little bit more about that.
Yeah, absolutely. Look, I think the CPF is a strong foundation, right? But we already covered it. The reality is, even if you want to lead a basic retirement lifestyle, after you account for the CPF contributions and what you get out of it, you're still having that gap inflation adjusted of $3,500 plus, $1,900 in present money terms, but inflation adjusted 20 years from now, 30 years from now, that is more than double. So really, you need to think about how do you plug that gap. And if you can, build that, bucket of investments that can help you plug that gap, I think it will only give you much more relief and comfort that I'm not still worrying about what's going to happen in the future. I'm well prepared for it. I think that's the most important and critical part of everyone's thinking. And I think when I shared that, the lady was investing $1,600 a month. It's actually very, very doable. And the reality is, as we age, we actually earn more. So the disposable income actually increases a lot more. And as we also go through some of our other life priorities, like child's education, upgrading of houses, etc. and all, once those are taken care of, those monies can be reallocated back to investing. So there is actually a lot that we can do in terms of optimizing for these long-term goals. You just need to be methodic and systematic.
So, yeah, go ahead.
Just add also, I think I've been working for about 13 years, right, since I graduated about 13 years ago, right? And one thing that I realized is that when you're young, you might think that you don't have a lot of money to invest because you earn a lower salary, and you think that, hey, when I earn more, then I will start to invest more. But one thing I realized, and I think that's why a lot of parents also want their kids to learn the right habits, is that actually your savings habits, your investment habits when you're young will bring you very far in life, right? It's like teaching your kids how to eat healthy diet when they're young, right? So when they become an adult, they naturally have the instinct to live a more healthy, more balanced diet. And it's the same thing with investing. When we start learning it when we're young, so what I do is that when I was very young, like maybe my first paycheck, I actually make it a point to do something for my retirement each month, each year, no matter what. It's quite insane if you think about it, because like, what am I doing at 25 thinking about my retirement? But thankfully at that point, I kind of intuitively know the charts that we're showing here, which is that when you invest at a younger age, time is on your side, right? When you invest at a later age, time is against you, right? Because imagine you only have 10 years more to retire. How much risk can you really take? How much investment cycles can you take? But when you have 40 years, time is on you. Time is your ally. It doesn't matter if there's a recession. Even better, just continue investing, right? And I think that's something that we need to learn at a very young age. The CPF system, I mean, we talk about the CPF system. Think of CPF like the government has to cater to the masses, right? So it's like all of us Singaporeans, we have MediShield Life. But on top of that, we also buy our own private insurance because we feel that even though the government only say this is compulsory, we need more than that, right? It's the same thing with our investment. We have our CPF, it's the base that the government thinks everybody needs. But by and large, most of you who are here, y'all think that y'all need more than just that. So, but how to get that? You have to start planning early. Otherwise, time is against you. The analogy I always give is that you plant a tree today, you can't expect 3-4 years it will bear you fruit, right? You have to wait 10, 20 years. But once it bear you fruit, as long as you take care of it, it will continue doing it every year.
That's a great analogy. Thank you for that. So a lot of talk about investments. Let's talk about the single most valuable lesson that you've learned. Investment lesson. Maybe Hazel, you can kick us off. In the last 5 years.
Okay.
So it's quite recent.
Well, for me, one of the most important investment lessons that actually every investor should learn and they should bear in mind is really about risk management. So a lot of times, like what Ritesh mentioned earlier on, people are always chasing after returns, right? You look at how your friends are able to make this amount of return and you think, okay, if I invest in the same thing, I will get the same amount of returns. But very little is being talked about on risk management. So the truth is that the markets move in both directions. So markets move up, it moves down. The upside volatility is what everyone loves because you make money, right? You make profits. It is the downside volatility that people hate. But unfortunately, whether you hate it or not, it is just part of this journey of investing. So the very important part is if you know how to manage your downside risk, actually the returns flow through you naturally. But a lot of people don't really understand this concept. And a lot of times we see, like those graph which shows us how if we start investing, say $10,000 today, how it will grow over time. Well, it is true. But we also have to consider the scenario, what if instead of making money, I lose money? So there are many instances where people take on too high risk. So in the end, they make certain uninformed investing decisions, and your wealth can also go down exponentially as well. So that is what happened to a lot of retail investors. So if we learn how to avoid taking too high risks, avoid this kind of big losses that can come as a result, we are actually helping ourselves to save our money and save time. Some investors, they invest for the last 5-10 years, they are in this kind of cycle where the wealth is just coming down, declining. So, but the thing is, well, even if you waste money is one thing, if you waste time, right, time is something that you can never turn around again. You waste the last 5 years, 5 years is gone. So that's why we want to be very careful about risk management. And, there's always a very common saying that if you're young, you can afford to take higher risks. Well, that is true to a certain extent, but I would suggest that even for young people, you don't want to take too excessively high risks. Because if you end up in a situation where you lose money, it's going to be very scary. And a very simple math example to go and think through about this risk and this losses is, just imagine today if you start out with $1,000 portfolio. After 1 year of investing, it drops to $500. So that's a 50% loss. But for you to get back from the $500 back to break even, the $1,000, you need 100% return. So a 100% return versus a 50% loss. To get back to only break even, you need much more effort. And that's only break even, right? But you have to get back to break even before you can start making profits. So that's why it's important to think about risk management as well.
Okay, lesson number 1, risk management. Tim, yours?
I am just going to put myself out there because there's been a long debate about lump sum versus dollar cost averaging. I'm just going to say that for most of us, it makes almost no sense to do a lump sum investing, which is to time the market. It's inefficient, and you are better off thinking on the dollar cost averaging, riding the ups and the downs of the market, as opposed to trying to time the market. right? Hazel was saying, we always say like, oh, you have to take the ups and the downs of the market. But I want to suggest that it's actually the down of the market, when the markets are down, where you actually build real wealth, not when the market is up. It's when it's down. It's when it's down and you continue to invest, which is where your best investment days are going to be found during recession. So actually, what you want is a situation where as long as you have a good investment approach, like for example, the Syfe portfolio, and you just want to be disciplined and you want to invest regularly, both through market ups and downs, and especially the downs, right? I think that is the biggest, a lot of things to do with investing is non-intuitive, right? We think that the market is good, everyone is coming in, we should invest, but it's actually the other way around that makes the most sense. So try to avoid timing the market, because in the long run, you will win if you avoid timing the market. There's these statistics that they say, right? On a one-day basis, right? If you invest in the stock market today and if a 1 day or a 24-hour timeline, your chances of getting a win is 50%. You flip a coin, basically. But at a 20-year time period, it's close to, if not 100%. So just think about that. What you need is time to work in your favor, not try to time the market.
Okay, now speaking of, go ahead, Ritesh.
I just wanted to add on to this, and just 2 points, right? Like, number one, how do you keep emotions in check, right? Because this is the single biggest factor why all of us falter. And the reality is, again, the fact that the stock market runs on a daily basis. We are just exposed to the ups and downs of the market, and we are forced to kind of like look at our portfolio, and whenever the market goes down, we are like, the world's coming to an end, and I need to take some action, right? Like that's typically what ends up happening with all of us. Like again, last week, markets were at all-time highs. It only dropped 5%, but I had calls coming in from clients saying that, should I sell my portfolio? There's an AI bubble and it's about to burst. What's happened this week? The whole market's come back. What happened during Liberation Day? Right, again, we had 20+% drawdown during that time. But 3 months after that, the markets rallied, and we are actually making new and higher highs as we have moved forward. So that's number one. The second point, I think, just piggybacking on what Timothy shared, dollar cost averaging, actually it's your biggest weapon. And in fact, like, when markets are going down, and especially if you are having a diversified portfolio and you know that, look, in the long term, things will be fine, this is where you can dial it up further. Like, I have another, suggestion, or we have another strategy. Instead of doing just dollar cost averaging, do enhanced dollar cost averaging. What that means is when the markets are just doing their normal, behavior, keep doing that monthly allocations. When the markets are down, double it up, right? So when everyone is fearful, you be the brave person. And what I say all the time to my clients is, when the markets are down, this is actually the worst time to sell. And it's actually the best time to buy, right? So that's my suggestion.
I know we're going through this panel quite quickly, and we could be here talking for a long time, but I do want to get to this question, which is, for a lot of people, the big question is, how much is enough? So how can someone start estimating? I know we brought out some formats earlier and some calculations there, but maybe Hazel, you can guide us through some ways.
The first thing you really need to think about is your lifestyle, right? There are some people out there, they can survive every single meal. I just eat hawker center, just eat coffee shop every single day. They are all right. But on the other end of the spectrum, you have some people who can only stay in the aircon. They can only dine in restaurants. And even within restaurants, you have the higher end restaurants versus the lower end, right? So you have to first figure out where are you at in this spectrum of lifestyle. So from there, that is where you can gauge how much do you think you will probably need to spend in a month, in a year, and then how many times do you need to travel typically in a year, right? Do you need to travel out far versus somewhere that is closer, whereby you don't need so much money? So these are the answers that only you have to answer. The answer of your neighbor on your left, on your right, they'll be different, right? So you have to figure that out. But even after you figure that out, it's not enough, because you need to think about inflation. So something that's $100 now is not going to be $100 10 years later or 20 years later. It's going to be much more expensive, unfortunately. So these are the things, assumptions that you have to put in place before you can go and do your calculations. And very fortunately, these days, we have a lot of retirement calculators out there on the different platforms. Just make use of them. Have your assumptions ready. Make use of them. Just put it into the calculators. You will have a rough guide on how much you will need during retirement. But even then, I would say don't treat it as like, die, I must have this number. It's just an estimate. And people can change.
You might think this is the lifestyle you want now, but 10 years later, you might have a different idea, right? So what is important is just a rough understanding, but more importantly is how do you get there, which is what we have talked about essentially right from the start of this session. You need to have different buckets of funds, diversification among that. So one bucket of fund is our CPF, SRS, as well as our cash portfolios, right? These three together, they will give us a more well-balanced and resilient portfolio. Why? Because they do serve different kind of objective. For example, your CPF, it's not just lying there doing nothing, but when you have your CPF life payouts, that gives you the stability and the peace of mind that you want to have when you are retired, right? On the other hand, when you look at, say, your cash portfolio, those are where flexibility comes in. You are flexible on what kind of investments to invest in. Some people want to do growth. Some people still want to do just income, dividends. So that is where the flexibility comes in. So together, these different buckets, or you can call it an income ladder strategy, is what gives us a more resilient and well-balanced portfolio for our retirement.
Go ahead, Tim.
For me, I just follow the government's advice, which is the full retirement sum. I think that's generally decent enough for most people for basic retirement in Singapore. But of course, like what Hazel said, not everybody's the same, right? So some of you might need more. Some of you might think that the full retirement sum is too much already, too good already, right? So it's really up to you on a personal level what you think you prefer. What I would say though is that I think the government's full retirement sum is really meant for the elderlies. So 65 and above. And if you're someone who is looking to get a bit more financial freedom before the age of 65, maybe in your 40s or 50s, then you need a different strategy, obviously, right? You can still have the CPF, but you also need a different strategy. And I think my suggestion, my advice for myself personally, and I'll share, is that I try not to fall in love with any strategy too much, right? Because I feel like a lot of people who I see, both older and younger, are biased, right? So a lot of older people will claim that property is the way to have financial freedom because they grew up in that era. My dad grew up in an era where if you bought a condo in the 90s, you'll be doing so much better today, right? So there's some inherent bias to it. A Gen Z will go into crypto because they think they see their friends going into crypto and how much they make. My suggestion is try not to fall in love with any strategy too much. Take a more neutral approach towards wealth building. You want to invest in some stocks individually. You want to invest in a robo portfolio that will be able to be managed well on your behalf. You want to use a bit of CPF. You want to put a bit of money into property. That's fine. Try not to just focus on one avenue of wealth building itself, because then that might make your retirement plan very contingent on just that thing working out.
Okay, so in the essence of time, Ritesh, I have a question for you, which is maybe you could share more about Syfe's approach to supporting the various stages of our lives.
Yeah, absolutely. And look, I think this is the reason why Syfe, when we think about how to build an investment a platform, we want to make sure that you get a holistic service from us. And which means that whether you're trying to save better, meaning that your cash lying in the bank, right now we don't get much, right? Interest rates are very, very low. Singapore, government bonds, T-bills, etc., less than 1.4, 1.5%, right? Not doing that great. So you really need to think about, like, how do you beat inflation? Inflation, now it is 2%, but it used to run much higher. So you have to think in terms of getting your money to work harder. So that you start with savings, right? So how do I save better? The second thing is, how do I invest for the long term? And that's where, if you don't have the time, or if you even have the time, I would recommend you to have this diversified portfolios to begin with. And that should be your foundation. And you automate your investment, right? So if there are three things that you need to take care, number one, stay invested. Number two, diversify. And number three, dollar cost average, right? And that you can do it very, very easily through the ecosystem that we have built, because we have features such as auto invest, meaning that you decide a monthly contribution level and you decide which portfolios you want to contribute and align it to the goals that you have in mind, and then just automate the whole thing out. And the third piece is, obviously, we have our brokerage platform as well. And the idea there is, look, all of us do want to have some of our investments kind of like aligned to our own views, a little bit of flexibility in terms of some of the things that we are watching in the market, and we want to take those exposures, et cetera, and all. And also personalization, right? So that's the reason we have the brokerage platform as well. But even in the brokerage platform, you have this same auto-invest concept. So for example, if you are interested, Magnificent 7 stocks are doing really, really well. But how do you invest? Do you buy each line item by line item? If I can create a bundle for you, and one click you can invest, that's how you can do it. And that's something that is already available on the Syfe platform because we have these concept of bundles. And whether you want to invest for the long term into like Warren Buffett kind of strategies, or you want to take exposure to some of the big things that are happening in the AI, semiconductor, et cetera space, these are all possible. But again, when it comes to investing, you're giving or you're getting all of these tools on the Syfe platform. But the more important thing is how do you allocate? And the idea there should be you build a solid foundation first, have maybe 60, 70, 80% of your money allocated to very diversified investments, and then add on these satellite investment strategies on top of it, where you can either use it to elevate your returns, use it to hedge your risk, or use it to personalize your investments as well. And these are things that we can enable on our behalf.
Now, Ritesh is still going to be around for the networking, so if you'd like to reach out and chat with him, plenty of opportunities later. In the essence of time, I'd like to put the spotlight on Hazel and Tim. Maybe just some final thoughts, one piece of advice to anyone, maybe Hazel, we can start with you, if they're starting their retirement investing journey today.
What you have to remember is you have got to trust the process, especially when you're starting out, and also during the entire journey. So a lot of people are always overthinking about how far away they are from their goal, that $1 million, $2 million, or how many $1 million goal that they want to achieve. And in the journey, you become very discouraged. So in the end, you only overthink and you don't take action. But what's important is you really got to trust the process and take action. Even if you're starting out with just a 10K small portfolio, it is fine, but focus on how to double that 10K to say 20K, and then just continue on with your 20K to 40K beyond. Eventually, you will be able to build out a bigger portfolio and reach whatever numbers that you're actually looking at. So you have to trust the process so that you are consistent, right? Because always remember this, all big things that you see come from small beginnings. Do not be envious about someone else, $1 million portfolio, because probably they also started from that small portfolio as well. Not everyone is lucky or fortunate to be born in a wealthy family to begin with, right? So that is where you have to just take it step by step and just trust the process.
I think I'll just share, like, for those of you who are in your 20s today and you're just starting your investment journey, I just want to say that, like, starting early is like the best thing you can possibly do. I did it. It helps tremendously when you're in your 30s. I'm sure it would be when you're in your 40s. Syfe is an amazing platform to use as well. Like, it wasn't there when I graduated, but had it been there, it would have been amazing because you get instant access to a diversified core equity portfolio that you can write you in the long term. I think that's the first thing. Syfe is also amazing in the sense that it has different products that caters to your different needs. So I still remember when REITs Plus was launched, that's the best way to invest in Singapore REITs, in my opinion, because you're taking essentially a REITs portfolio and you don't need to choose which REITs is better, right? The portfolio manager has already done the work for you. You simply invest in a diversified portfolio of REITs, and that gives you the kind of dividend income that a lot of people are seeking in Singapore. And obviously there's Syfe Trade as well. So once you become a bit smarter and more confident, you want to take tactical bets, you can do so as well. Just keep it to a small part of your portfolio. So I think for those of you in your 20s, like today, the investment options today are way more amazing than it was like 10 years ago. For those of you who are older, the only advice I would say is like, the analogy I'll give is like revising last minute for your exams, right? You have no choice. You have to work doubly hard compared to somebody who started a bit earlier. But it's okay. Sometimes you just have to, if you have to mark for your exam last minute, you have to give up all your meetings with people, don't meet up with your friends so much. That's okay, right? You can give up a car, you can give up a couple of annual trips. Before you know it, that amount will compound as well. So even 10 years is enough as well. So if you're young, start now. If you're a bit older, you think you're going to retire in 10 or less years, just double up. It's okay one.
Thank you so much, Tim, Hazel, and Ritesh. Can we give our panel a warm round of applause? Amazing stuff. Now, I know we kept the timing of our panel quite short, but feel free to connect with our various speakers on LinkedIn for more chats with them. And for now, thank you so much for being on our panel. I'm going to hand things back to Kenny.
Wow, great insights, everybody. I don't know about you, but I've been taking notes, so let me just give a little bit of debrief. So, spoken by Timothy, one of the key things he spoke about is time is your friend. is your essence, right? So please make use of it and start early if you can. From Hazel, risk management is key, right? Because you don't just want to talk about the gains, you also want to worry about your downside. Of course, Ritesh, let's learn how to manage our expectations and emotions. Stay true, stay invested, be safe, right? So, next up, I'd like to invite our good friend here, Arman, Director of Portfolio Construction and Quantitative Research. He'll be doing the closing for us today. And of course, let's hear a bit more from Arman. Arman, please.
Thank you, Kenny. Evening, everyone. Pleasure to be here tonight. So I'm going to start closing on a retirement event, talking about the future, but I'm going to go back into the past first. So when I was 6 years old, every week I would take my pocket money, a £1 coin, and I would insist on taking it to the bank whenever we went shopping. I'm deadly serious. I did this. It sounds a bit odd. Probably a few people in the room are surprised, but for those who know me, I think it makes sense. I've always been a numbers guy. Now, what I wish I'd done then, and I wish I knew then, is how little it would earn in the bank. What I should have done, of course, is ask my parents to invest it. Now, why do I tell this story? That amount of money is obviously not life-changing for a child. Would have got some more sweets. But when we're talking about retirement, and we're all planning for that here, the amount of money we're talking about and the choice of investment is really crucial. It's going to have a lasting and significant impact on our quality of life during retirement. Now, what we have here is 4 different scenarios. In each of them, someone has invested their full SRS limit, $15,300 for locals and PR, from age 40 to 63. The amount they've invested across these 4 different scenarios is the same. But what's different is the investment product they've used. In the first example, they've left it in their SRS bank account, which I think we all know generates 0.05%. As you can see, what they're left with is essentially what they put there. That would have been me when I was 6. Now, if we move across to the right, you can see even once you're putting it into cash, at least a couple more percent. This is a more stable product, and of course, those returns add up over time. Now, where it gets really interesting and where the compounding does the work for you, as I'm sure you all know, is when you start to look at higher yielding products. Taking a blend of our Income Plus and Equity 100 as an example, something reasonably stable at 6% annualized return, a blend of them, you can see that you're doubling your money instead. And of course, if you want something that's much more focused on growth, then our Equity 100 portfolio, you'd see almost triple what you would be investing. Now, what this tells us is it's really important, especially for retirement, that we select our investment product carefully and that we do invest into the returns that we are aiming for in generating our nest egg that we're looking to retire with. Now, earlier, Ritesh touched on the 3 different SRS eligible products that we offer at Syfe. What I'm going to do here is just highlight the landscape in front of us, starting with Cash Plus Flexi. Now, Ritesh touched on where government rates are right now, what you can get in a bank account, and here at least 1.8%. It's something a bit better than we can get in government bills. Cash Plus Flexi, of course, is for people who are looking for stability. There's no lockups with this. This can be a shorter term investment if you need that money in the decumulation phase of your retirement. Moving across to the right, Income Plus. If you're looking for something with a bit more yield, With this product, we've partnered with PIMCO, a leading asset manager in the fixed income space. And what I'd like to highlight to you here is if we compare this to a unit trust, for example, often there the fees can be substantial, 1 to 2% annually. There's access charges, sales charges as well. So looking at Income Plus with a greater than 6% annual yield, which is paid out monthly, you really get a cost-efficient access to good fixed income. Now, obviously, our long-term growth engine, Equity 100, it's something I spend a lot of my time thinking about. There, you're getting double-digit returns on average over the last 8 years, and indeed again this year. Again, here, Sam touched on this earlier. In the global landscape, active portfolios and equity funds tend to underperform. I think only 18% have outperformed. When we add on fees on top of that, again, similar to the Income Plus landscape. Some of the unit trusts here can have 1 to 2% fees, access and sales charges on top of that. Syfe Core Equity 100 is a cost-efficient way to get long-term growth. We select our funds from leading managers with strong track records. We go very much into the detail with our partners there. Now, for those who want to keep learning after tonight, our website has a ton of information about SRS and, of course, all our portfolios and the latest market news. I highlight here 3 of our more recent SRS articles that we've put out, the differences from CPF, but also an overall comprehensive guide on what SRS is, as well as an article on using SRS as a foreigner. It's something that foreigners in Singapore don't potentially use enough of. It's actually, there's a higher limit for foreigners in terms of your annual contributions you can make. And all these articles are available on our website. Now, how do you actually get started with your SRS investing at Syfe? First, of course, you have to fund your SRS bank account. After that, you can add this bank account into your Syfe app. You go to Manage Portfolios. At the top, there'll be an SRS sale card. After that, you pick which portfolio you want. We talked about Equity 100, Income Plus, and so on earlier today. And then you select your SRS bank account and make the transfer. Now, we've gone one further than Black Friday for you today at Syfe. This promo is available for the rest of the year. If you're new to SRS investing and you use this promo code, which is on your leaflets as well, you can get up to $1,500 in fee credits, depending on your investment size. Now, all that's left is for me to thank our speakers, our panel, and of course, all of you here for being here tonight and continuing with your trust in Syfe. I hope this evening was insightful and you've been able to think a little more about your retirement and the strategies that you need to employ going forward. We will shortly be having some light food to the right, out through these doors, and then again to your right. There's plenty of food. Make sure you take a fair share. Ensure there's plenty to go around. Syfe employees will be there in T-shirts, guiding you to the right spot to queue. And of course, if you have any follow-up questions, all of my colleagues are here in Syfe T-shirts. We'd be more than happy to continue the dialogue there. Thanks again for being with us tonight.